I am confident that the Chinese will want to reach a deal. And as I said, this is going to be a multi-step process. First, we need to de-escalate, and then over time, we will start focusing on a larger trade deal.
Scott Bessent, one of the loudest cheerleaders of the current U.S. trade policy, made an astonishing claim last week that supply chains won't be affected. On paper, it sounds reassuring. In reality, it borders on economic gaslighting. Because while Bessent smiles for the cameras and insists everything is under control, something far more alarming is happening behind the scenes. A full-blown supply chain collapse is unfolding in real time, and most Americans don't even know it yet. This isn't just about higher prices. It's about empty shelves. In the coming weeks, U.S. retailers may run out of goods entirely. Not because people can't afford them, but because they're simply not there. This is no longer a crisis of inflation. It's a crisis of disappearance. Everything from household appliances and electronics to basic medications, clothing, and even food staples is vanishing from import schedules. And soon, they'll vanish from stores too. The shipping data tells the truth that officials won't. Starting this May, container traffic from China to the U.S. is projected to plummet, with the Port of Los Angeles bracing for a 35% drop in volume within days. Entire categories of imports aren't being delayed. They're being cut off. In some sectors, trade has stopped completely. Nearly 90% of medical products on American shelves contain Chinese components. And even giants like Walmart rely on China for an estimated 60% of their inventory. This didn't happen overnight, but the unraveling might. So ask yourself, what happens when the supply chain doesn't just strain, but snaps? Store managers are scrambling for alternatives that don't exist. Importers crushed by tariffs are backing out. And the White House keeps insisting everything is fine. No one wants to say it out loud, so let's say it clearly. You won't just pay more. You may have nothing to buy at all. But before we dive into the hard data, make sure you're subscribed, because what you're about to see is just the beginning. For months, we've heard about a so-called pause in the US-China trade war. A 90-day timeout, they called it. A window for peace, talks, maybe even progress. But here's the truth. There's no real pause. Behind the press briefings and smiles, the conflict isn't cooling. It's accelerating. Look closely and you'll see the signs. Major U.S. ports, Long Beach, Oakland, and Savannah, are slowing down. This isn't a hiccup. It's a warning. A supply shock is brewing, one that could gut-punch the U.S. economy. Fewer goods means emptier shelves. And when the same amount of money chases fewer products, prices spike. That's basic economics. Now imagine the shelves going bare. Who will Americans blame when they can't find essentials or when prices triple overnight? Beijing or Washington?
Happening now, the last ships from China bringing cargo unaffected by President Trump's massive new tariffs are sailing into American ports. So that means the countdown to supply shortages and rising prices has officially begun.
The shipping industry is already feeling the pinch. One of the major global carriers, Hapag-Lloyd, reports that 30% of the container bookings from China to the U.S. have been canceled. And it could get worse. Experts warn that by the end of May, Chinese exports to the U.S. might slow to a near halt. The reason? A massive 145% tariff imposed by the Trump administration on a wide range of Chinese imports. That's a price hike most companies just can't afford. Importers are cornered, absorb the tariff and bleed money, pass it on, and sales evaporate. Many are simply canceling orders. That means fewer products on shelves, reduced spending, and eventually job losses. It's a domino effect. Yet the White House insists everything is fine. Treasury Secretary Scott Bessent even claimed that American retailers have already stocked up, so there's no need to panic.
We have some great retailers. I assume they pre-ordered. I think we'll see some elasticities. I think we'll see replacements. And then we will see how quickly the Chinese want to de-escalate.
But here's the thing. Just because goods are pre-ordered doesn't mean they're safe from tariffs. Those orders still have to pass through customs, and when they do, they'll get hit with the same 245% tariff. There's no workaround. The math doesn't lie, and pretending otherwise won't change what's coming. Bessent also keeps repeating a favorite talking point, that the US supply chain is flexible enough to shift away from China. He suggests that we can just start buying from countries like Vietnam or Indonesia instead. But in reality, switching suppliers isn't as easy as flipping a switch. Vietnam, for example, is already under strain. A 10% tariff was quietly imposed in March and could rise to 50% once the grace period ends. The US suspects Chinese companies are rerouting goods through Vietnam, so it's cracking down there too. At the same time, it's getting more expensive to ship from Vietnam. Shipping costs are already up 23% in April alone. That extra cost gets passed right on to American consumers. So even if we stop buying from China, anything we buy from somewhere else will still cost more. It's not just the tariff, it's the transportation, the delay, the lack of scale. The bottom line is simple. The idea that we can easily replace China in our supply chain just isn't realistic. So what's next when Vietnam gets too expensive? Cambodia? Bangladesh? These countries lack the capacity to meet US demand. China's dominance was built over decades of infrastructure and scale. It can't be replaced overnight. That said, some analysts believe that painful shocks like this are exactly what's needed to spark investment in alternative supply hubs across Southeast Asia and even the US itself. Another major argument Bessent keeps making is that because China sells more to us than we sell to them, we have the upper hand. He believes that gives the US leverage, that China will fold first because they need our market more than we need theirs. But that logic overlooks a key fact. The US has a trade deficit for a reason. It imports far more than it produces. The country relies heavily on foreign goods, and when those imports are disrupted, domestic production isn't sufficient to cover the gap. This leads to shortages, driving prices higher and impacting American consumers quickly and severely. China, meanwhile, has been preparing for this. For years, they've worked to reduce reliance on the US. The US, by contrast, keeps relying on old tricks, printing money, expanding credit, and hoping consumers keep spending even as savings dwindle and prices rise. It's a dangerous gamble in the middle of a supply shock. So while Washington insists this 90-day pause is a win, the facts say otherwise. This isn't a pause. It's a countdown. Once the grace period ends, tariffs will rise again, and the pain will deepen. No country is ready to replace China. No retailer can absorb a 145% increase. No consumer can keep up with runaway prices. This trade war is no longer about policy or prestige. It's about real people. The mom who can't find baby formula, the small business owner with empty shelves, the truck driver with nothing to haul. And the worst may still be ahead. The US economy is starting to feel like it's running on fumes. All the warning signs are there. Layoffs are spreading, people are spending less, and companies are pulling back on investments. It's a cycle that feeds on itself. When businesses don't make money, they cut workers. When workers lose jobs, they stop spending. And when spending slows, businesses struggle even more. It's the kind of loop that's hard to break one. The Atlanta Federal Reserve just put out a troubling number. They think the US economy might shrink by 2.5% in the first quarter of 2025. If that happens, we're not just talking about a slowdown. We're halfway into a recession. And instead of trying to ease the pressure, the White House is doubling down. Trade Representative Scott Bessent is reportedly pushing for even harsher measures, including banning entire product categories like airplane parts and electronic components. That's not just a jab at China. That's a punch to the gut of our own economy. This strategy isn't clever negotiating. It's risky, reckless, and at this point, downright dangerous. Every time the US slaps tariffs or bans something, other countries hit back. They raise their own tariffs or block our products from their markets. It becomes a game of back and forth punishment that keeps dragging everyone down. And the harder Bessent pushes, the more it chips away at America's already fragile GDP. When both countries are armed with powerful economic tools that can hurt each other and both believe they can outlast the other, it turns into a dangerous standoff. But what happens when your economy is the one that's already bleeding? People keep asking whether the Federal Reserve will step in with its old tricks. In the past, the Fed would jump into situations like this with something called quantitative easing, basically printing money to buy government debt and keep interest rates low. But this time, that plan might not work. The US government needs to borrow over $514 billion this quarter alone. That's more than $500 billion in just a few months. That much debt hitting the bond market all at once is like throwing gasoline on a smoldering fire. If the Fed starts buying up those bonds again, it could make inflation worse instead of better. Yields could go up, not down, which would spook investors even more. Meanwhile, everyday Americans are still getting hit by high prices. Inflation hasn't disappeared. It's just hanging around stubbornly. Consumer confidence is sinking fast. People are worried about their jobs, their savings, and whether they'll be able to keep up with the rising cost of living. According to the University of Michigan's latest survey, confidence is at one of its lowest points in years, and people are expecting inflation to stick around for longer. The bottom line is that the Fed is stuck. If they pump money into the economy, inflation could spin out of control. If they tighten things up and raise rates, they'll choke what little growth we have left. The only real way to stop this downward slide is to end the trade war. But so far, Washington doesn't seem interested in taking that path. There's another crisis brewing, and it's happening behind the scenes in the global currency markets. As the US dollar continues to lose value, exporters, especially in China, are rushing to exchange their dollar earnings for their own currencies. It's not about avoiding sanctions or making a political statement. It's basic economics. When the dollar gets weaker, every dollar they earn today will buy less of their local currency tomorrow. So they're cashing out now while they still can. It's not just China. Exporters all over the world are doing the same. They're dumping dollars and converting them into yen, yuan, francs, or rubles. Even countries that are trying to keep their currencies weak are seeing them rise against the dollar. That puts even more pressure on the dollar and adds fuel to America's inflation problem. It also makes investors nervous, especially those holding US debt. So if everyone is rushing to get rid of dollars now, who's going to be left holding the bag? What's even more alarming is that it's not just private exporters walking away from the dollar. Foreign governments, some of America's closest allies, are beginning to quietly reduce the amount of US dollars they're holding in their central banks. Countries like Germany, South Korea, and even Canada are slowly shifting their reserves out of US assets and into their own currencies or gold. Not only is Germany shifting from the dollar, but it is also planning to move its gold reserves away from the United States. It's not only about economic safety, it's also about trust. These countries watched how the US froze Russia's foreign reserves in 2022. That sent a clear message. If relations ever go south, your money might not be safe in American hands. Now they're hedging their bets, and they're doing it by pulling out of the dollar. This shift is hitting US bond markets hard. Foreign demand for long-term US debt is drying up fast. At a recent bond auction, international buyers showed up in far fewer numbers than expected. That's not just a warning sign, it's a flashing red light. US banks, already under stress from rising defaults and tighter regulations, don't have the capacity to soak up all the excess debt. And the craziest part? This entire mess is largely self-inflicted. The trade war may have started as a way to protect American industries, but it's spiraled into something much bigger and far more destructive. We're punishing ourselves more than we're punishing our rivals. And yet, the people in charge keep doubling down as if pain equals progress.